Hello, this is Chad Karnes, Chief Market Strategist at ETFGuide.com. Thanks for joining me today as I talk about the recently enacted Volcker Rule and will it take down financial stocks. The Volcker Rule isn't the Volcker Rule according to Paul Volcker himself, but he is happy with its balance between principles and rules. The latest response by regulators to tighten their grip on Wall Street was completed on December 10th, and the 71-page rule book, along with 850-plus pages of legalese, has finally been put into law. On the screen, I show the final Volcker Rule, and it's 954 pages in all its glory. So you'll see here the final page, 954. Did I read it? No. And why didn't I read it? Because it doesn't really matter to financial stock prices anyways. The Dodd-Frank Act, on the other hand, was enacted in July of 2010 with a backdrop of negative sentiment for financial stocks. It had a surprisingly positive effect on bank share prices, whether coincidental or not. The Dodd-Frank Act actually helped mark the stock market lows for 2010 when the S&P 500 traded as low as 1011. And I put that chart up here to show the timing between the two laws. This offered up a wonderful buying opportunity for financial shares such as JP Morgan, Goldman Sachs, Bank of America, Citigroup, pretty much anything in the markets. The Volcker Rule, on the other hand, was recently enacted after a 2.5-year bull market that started back in 2011. So notice the Dodd-Frank was passed after a significant market pullback, whereas the Volcker Rule was passed after an elongated market rally. As such, when the Volcker Rule was passed, Wall Street kind of just shrugged it off and didn't really care, whereas the Dodd-Frank got a lot more attention after a pullback in the markets. A rising tide lifts all boats, the saying goes, and financials have, like the rest of the stock market since 2011, responded to all news, good or bad, by rising. According to Bloomberg, the 2013 rally is now the broadest on record, as 447 of the S&P 500 stocks have risen. Onerous rules or not, the market doesn't really care about any of these regulations. As a result, relying on the ever-changing regulatory environment to help you decipher the market's next moves likely won't help much either. This is why we utilize technical and sentiment analysis at ETFGuide.com alongside the fundamentals to try to stay on the correct side of the markets. So what exactly are these charts saying that the fundamentals aren't currently providing? So the first chart I'd like to show you is of the financial sector. And show you that something happened in August 2013 that has not occurred since financial stocks kicked off their abnormal rally from June of 2012. Financial stocks actually started to underperform the S&P 500. The chart shown was provided for subscribers in our September ETF Profit Strategy newsletter and commented on the potential breakdown of the financial sector. And you can see on the chart that the relative strength, which is the XLF, which is the ETF that follows the financial sector, divided by the S&P 500 as a whole, was starting to test a key trend line that had held multiple times since 2012. A few days later, after this was published, the financials indeed broke down from this trend line, confirming they were no longer the leaders of the market. This updated chart shows that. And it also shows that portfolio managers must have been pressured to shift out of financial stocks and into other better performing sectors, driving financial share prices down relative to the S&P 500. This indeed seems to be the case, as the chart is updated through today, and the larger section shows that this underperformance by the financial shares continues 6 months later now into December. In fact, only the utility sector has underperformed the market by more since it also broke down this summer. As discussed in our September ETF newsletter, if XLF and one other very important sector that was discussed with subscribers both break down together, it will be something that hasn't occurred since the rally from 2009 started, and will be a big warning sign that the market is shifting out of its former leaders and becoming more defensive. This shift from leaders to defensive often accompanies major market turning points. Although financials are already underperforming the broader sector, as shown in the larger red section here, thus far it hasn't meant an outright decline in their share prices, as the top chart shows the uptrend in financials, although now less of an uptrend and showing less strength, continues to be an uptrend nevertheless. And until it's joined by this other sector that we talked about, the longer-term price uptrends will likely remain intact. Luckily, we have the tools to warn us when these changes in the market occur. For now, underweighting financials and staying long the broader market is one way to take advantage of a lagging financial sector. This middle section shows that would have profited a few percentage points by being long the S&P and shorting the financials. You would have been essentially market neutral and capturing a positive outperformance in the S&P over financial shares. Aggressively shorting financials isn't the right call yet. However, the relative weakness of financials compared to the broader market suggests that time is likely approaching. A breakdown in the financials technicals will suggest a decline in financial stock prices is underway and a clear opportunity for the bears. And this trend line right here in red at top is something I am watching to warn of such an occurrence, that when the financials finally do break down from their trend, offering short opportunities in financial shares. On the other hand, if you're expecting the latest Volcker rule to rattle financial stocks like what occurred when Dodd-Frank was passed, it's probably not going to happen. Waiting for confirmation first, such as a breakdown in price, is a much better way to play a market with a tide that's lifting all boats. Thanks for joining me today, and please check out some of our other videos at etfguide.com, as well as our Twitter feed. We also offer a monthly newsletter, ETF Picks, and I also do a few times a week technical forecast, where I follow the financial and other sectors as I watch for a key breakdown to occur that would warn of a larger potential market downturn. Thanks again.